Good afternoon, everyone. Thank you so much for joining us today, and welcome to Pring Turner's 2024 Summer Client Event. We are super excited to have you with us today and to talk about some really important updates with you. But first and foremost, we do have some important matters to discuss first, just some basic housekeeping. And that's just to remind you that the information presented today is simply for informational purposes only. It is not specific investment advice or portfolio specific advice. And as much as we'd like to have a crystal ball into the future, we simply don't. And so our views presented today are subject to change, just as the financial markets and other factors inevitably change over time. But with that, I am super excited to introduce our speakers today and the key topics that we're going to cover. So first, Katie is going to talk about really important operational and client service updates. And then Joe is going to walk us through an inflationary update. Martin is going to offer a business cycle review and also talk about some opportunities there. And then Tom and Jim are going to wrap things up with a portfolio review and a market outlook. And then we're also going to finish with a live Q&A. And so with that, you're welcome to save your questions all the way until the end, or feel free to ask your questions at any time throughout the event. We'll be able to keep track of those. They will remain anonymous. And the entire team and I, we're going to be available at the end for as long as it takes to answer all of your great questions. So we really look forward to that. And without further ado, Kate is going to kick us off with some important service updates.
Not so much anything new, but just a really nice reminder. As time goes on, a lot of you are asking for more electronic versions of items, and we do have the Pring Turner Vault in place to make this happen for you. Not only is it a way that we can share your quarterly reports electronically, but it's also a way that you can send us sensitive documents with Social Security numbers, account numbers on there, a secure way to share those items. It gives a portfolio overview when you get logged onto the Pring Turner Vault, and it's basically just a one-stop shop for us communicating and sending items electronically. So if you do want to get this set up, if you're not already, call anytime. I'll be happy to walk you through the process. It's very easy, and I just wanted to give a nice reminder. We have that in place should anybody still like to receive more items electronically from Pring Turner. So that's it.
Thank you so much, Kate. And next up, we have Joe. He's going to take the floor talking about inflation and volatility and give us some information and updates here. So Joe, the mic is yours.
All right. Inflation is one of the most critical inputs to our decision-making process. Martin wrote in his book in 1982, The All-Season Investors, that the investors' greatest enemies are inflation and volatility. And that is the gist of my discussion today. So inflation has come back, and we haven't seen it for a long time. So what you're looking at here is there's many different ways to measure and look at inflation. This chart is a picture of the Federal Reserve's favorite inflation index, which is called, not the CPI that comes in our published all the time, but is measured by the Personal Consumption Expenditure, PCE index, excluding food and energy. So this is a picture of inflation if you don't eat and if you don't heat your home or drive a car. So there is no perfect measure of inflation is what I'm saying. But what we do have here is a picture that inflation has been a non-event. It's been lower and slower and basically nothing on the horizon, nothing to worry about since the 1980s. And then here, coming out of the pandemic, we saw a real burst of inflation. And the problem is, and the question is, has the Federal Reserve let the inflation genie out of the bottle? So they shortly said they didn't have, that inflation was transitory. We found out it wasn't transitory. The Federal Reserve, mea culpa, we thought it would we'd have it under control before now. They haven't. So what we're looking at and what the target is for the Fed is to have a 2%, get inflation down to a 2% level. And this is the whole problem that faces us as investors is, does this inflation picture create new risks and or new opportunities for investors? And the answer to that is yes. So the problem is inflation affects all of us a little differently. So the mud puddle is measured by the black paw prints there, leg prints, if you would, on our two canine friends. Inflation's the same for everybody, except we go through it differently. So if you have assets and you can finally get 5% return by parking money in short-term bonds or money market fund, it's like you're looking pretty good. If on the other hand, you're low income, middle income, lower income, you don't have assets. In fact, you have more liabilities. You have credit cards, you have balances on your credit cards, and you have loans out, and you have nothing in the way of assets. You are hurting with inflation. So the problem is it affects us all differently. And on top of that, not only affecting us differently, the problem of defining inflation is itself an issue. And that's the next chart, which shows us that there are many, many different ways of assessing and analyzing and measuring. And the problem is there's no good way to define inflation. And there's different levels of inflation. We have deflation, prices going down. We have inflation. We have stagflation, where economic growth is flat and inflation is up. And we have hyperinflation. So we have inflations all over the board. The two things to remember, most importantly about inflation, is one, the way I define inflation is it lowers our standard of living. And if you say inflation is up 3% or 5% this year, that means that I can purchase, or my assets will purchase 5% less goods or less services than it did a year ago. Or I have to lower my standard to get the same values out there. So inflation lowers our standard of living. And the other thing is you're looking at that one box in the center lower part of the chart is the U.S. inflation aggregate. What that is there's a new organization called Trueflation, and they, to their word, to their title, are attempting to measure truer inflation. And you see that 22.37. That 22% is the cumulative effect from the beginning of 2020 until the beginning of 2024. So in 4 years, you're seeing inflation rise 22%. Probably by the end of this year, we're going to be pushing 25% inflation. That's 25% lower standard of living. And remember, inflation is cumulative, and you feel that when you go out shopping. So the biggest problem is defining inflation, and then also the fact that it is cumulative. So to summarize, inflation is one, it's back again. And secondly, as we've seen from the Federal Reserve trying to manipulate monetary policy to get inflation under control, inflation determines monetary policy. For us, it drives the asset allocation. When inflation is high and rising, it dictates one asset portfolio. If inflation is low or declining, it determines another asset allocation. And finally, the most important thing, as we see from that Trueflation chart, where in just 4 years, 5 years, we're going to have a lower standard of living by a quarter of what you have, it certainly helps to bring that into your investment and your retirement planning. So those are the keys about inflation. And then I want to couple this with inflation's first cousin, if you would, and where Martin says the two greatest enemies are inflation and volatility. That's the second component to talk about. And I define volatility as the price action that happens once reality meets expectations. And this is the investor's other great enemy. Or if you're aware of inflation, its effects, its trend and changes and levels, and you calculate that we are going to get volatility in markets, especially when we get into inflationary times, those don't become your enemy. Now they become your allies. So that is the part that we're going to talk about here, in that volatility can either be a risk if you're unaware of it, if you're not putting that into your decision-making process, or it becomes opportunity. And what you're looking at here is a chart, and all this is reflecting over the last 70, 80 years, price volatility, how much price of the S&P 500 deviates from its 12-month moving average. And you can see maybe on average, the market has typical volatility. It'll go up or down 14, 15%. That's pretty typical. You get extremes when the markets are really quiet and not volatile, down there at 4, 5, 6%. The ones that become a little worrisome are the volatility that are above the 20% level. And what you'll notice, if you look at where those spikes in volatility happen, oftentimes they're related to bear markets or inflation or things that are nasty, have nasty effects on the market. You've got 1968, 69, 70. You've got the 1986, 87 crash. You've got the 2000, 2001, 2002 market decline where it dropped 50% over a couple of years. Those are when you see volatility up there in the 20, 25% level. And of course, the two most recent spikes on the far right are the most recent one is 2023. The market dropped 20-odd% in a year. And just before that, of course, would be 2020, the huge spike where the market dropped 30+% in just a few months. So this is a picture of volatility, and whether it's risk or opportunity depends on if we're aware of it. We calculate that, we put that into the risk management process, and calculate that into our investment process. So what do we see in the future in terms of volatility, price volatility? And do we expect to see more or less? And there's a lot of things that have happened that I'm going to call the market structure features that have happened that tend to lead us to more and more price volatility. And bottom line is, this is risk for passive investors, but it's opportunity if you're active investors. So just to summarize or finalize my comments here, one, I believe inflation is back, something we haven't seen for 40 years. We have at least one, if not two generations that have never had to deal with inflation as part of the decision process or affecting it as much as I think we will. The 2% inflation target that the Federal Reserve has set up, I think that's problematic. Oh, we might hit 2% for a month or two or three, but I think there's a lot of things in action that I think make it problematic that the Fed can achieve their 2% inflation target and stay there. So I think they're going to have a problem. And then finally, expect volatility that happens with inflation coming back, market structure, where we are in the secular trend. These are all things that would lead me to believe we can expect more volatility in the playground that we're out there. So the best quote, I think, is Leon Martin's volatility, inflation and volatility are the greatest investors' greatest enemies. Our Ed Easterling is a retired hedge fund manager, author, researcher, has a quote, and I think that applies to what we are seeing now. and that is, as investors, sometimes you can sail, sometimes it's easy. Sometimes you just sit back, go on your course, and there's very little work to be done. Other times, you have to row. And for that, I'm going to turn this over to Martin, long-term partner. I'd like to say that I've taught Martin everything that he knows, but I can't say that. So Martin, take it away.
Where to, Joe?
Wherever you want to take us.
Thank you very much, and good afternoon or good day, everybody. I'm going to be talking about the business cycle and how we allocate assets around the business cycle, because the business cycle has been with us for something like 250 years or more, since the recorded economic history at the beginning of the 19th century. And the business cycle is nothing more or less than a set series of chronological sequences. Imagine going into a recession, interest rates start to come down, and people who build houses start to think, oh, housing is becoming more affordable now. I can build some houses and make some profit. So the next thing that has to happen, of course, is those houses have to be furnished. You've got to buy appliances and so forth. So a different section of the economy then revives. And then eventually, the people who make the appliances decide to expand their plant and capacity. So capital spending comes in. So there's a definite chronological sequence that goes on during a typical cycle. And what we can do is we can break that down into three different indicators. A leading indicator, an indicator that's made up of a composite indicator made up of lots of indicators that lead the economy. Then, excuse me. Then the coincident indicator, and then the lagging indicator coming up in the rear. Now, when we talk about the economy, there's really no such thing as the economy, because as you can appreciate, you've got lots of different sectors of the economy doing different things at different times. So when we refer to the economy, we're really referring to the coincident indicators, ones that move a kind of in the middle. Imagine a train with the engine in the lead, caboose in the back, and then the carriages in the middle. Well, those are the coincident indicators, the carriages. And a business cycle is kind of like a train going around a circular track. First thing you see is the engine, and the next thing you see is the carriages, and then the caboose, and it goes round again. That's what this diagram helps to show you as well. So the leading indicator is the first to peak. This is the momentum of the leading indicators index put out by the conference board. And it leads the coincident indicator at each cycle. The magnitude of each rhythm is different in each cycle, and the leads and lags are different. Look at this one over here. It's a long lead because the arrows slants very much to the right. But the other thing is that the coincident indicators lead the lagging indicators. And you can see that if you take a look at 2010, for example, here's the lagging indicators down here just starting to turn up. And there's the leading indicators just starting to turn down. So there's a cycle going on between all these indicators all the time. Now, the good news for investors is that there are bonds, stocks, and commodities. Their turning points, the primary trend, are typical, or I should say, part of the business cycle sequence, which we'll see in the next slide. There's two things I want to mention. First of all, that thick black line you see is the growth path, or the theoretical growth path of the economy. So when it's below the orange equilibrium line, that means the economy is contracting, and then it contracts at its most maximum, and then starts to contract at a slower and slower pace until it actually starts to expand. And the other point to bear in mind is that we've got the diagram split into different rectangles, colored with different colors, and numbered 1, 2, 3, 4, 5, 6. Those are the 6 stages of the business cycle that we recognize in our investment work. It starts off in stage 1 during a recession, where the demand for credit starts to come down because of the weak economy, and the supply of credit increases because the Federal Reserve is panicking at this point, trying to push as much money into the system as possible. So when you have any situation where the supply is increased and the demand is reduced, the price comes down, and the price of credit causes interest rates. And bond prices move inversely to interest rates. So the first thing to bottom during a recession is the bond market. Eventually, the players in the stock market realize that these declining rates are going to help stimulate the economy, and they buy stocks not when the recovery takes place, but in anticipation of the recovery. So this is why you see the irony at market bottoms of the news being the blackest, because if it's at its blackest, it can't get any worse, and the recovery is about to get underway. So that's why stocks bottom out during a recession. As we move along, so the balance of demand and supply comes more in balance on the demand side for commodities, and commodities bottom out. So this stage here, we got all three markets going up: bonds, stocks, and commodities. But like with all good parties, they must all come to an end. And as the commodities get more intense in their advance, so the players in the stock market and the bond market realize that the Fed is probably going to come in and maybe raise interest rates a little bit, or maybe credit demands have started to pick up. So the price of credit, interest rates start to move up. A lot of people think when we get this initial rise in interest rates, that that's the end of the stock market, bull market. But just remember, rates at this point are going up and they're going up very gently, and they're going up because commodity prices have not really overheated, and profits are going up at a faster rate than interest rates. So the stock market is able to peak out right at around the point of maximum growth. And in the next slide, but one, I'll kind of demonstrate how this works in the real world. But then the growth path of the economy starts to come down and commodities peak out. So we use this as a kind of a map for allocating assets. So first of all, bonds are bullish for three stages. That's stage one, that's stage two, that's stage three. And it's 1 and 2 and 3 for bonds. Stocks are bullish for stages 2 to 4, and commodities are bullish for stages 3 to 5. So you can see that certain parts of the cycle is very good for investing in everything, bonds, stocks, and commodities in stage 3. Stage 1, you want to be emphasizing deflation-sensitive assets, such as bonds or interest-sensitive stocks. And then at the other end of the cycle, you want to be emphasizing commodities or commodity-sensitive stocks like energy and mining. So that this business cycle and this approach is kind of like a seasonal approach, just like the calendar year. Just in the calendar year, there's a certain time but you want to go skiing, and there's a certain time you want to start planting for the spring, for example. The same thing is true in the financial markets. So the big question is, where are we now? Well, we determine that by the fact we have 3 different models, or what we call barometers. Well, right now, commodities are bullish, and stocks are bullish, and bonds are bearish, which puts us in stage 4. So here's one of our models. This is our commodity or inflation barometer. Consists of 4 components. When they reach 50%, which is this horizontal line just here, the barometer goes bullish for the 6-stage cycle analysis. Right now, the indicator or the barometer is at 100%. It can't get any higher. That's the maximum reading. And you'll notice we got some green highlights on against the CRB spot raw industrials, which is our commodity indicator we follow. And that occurs when it's at 75% or higher. That's when you get one of those green highlights. You can see it captures pretty well all of the major advances that have taken place since this chart's inception in the mid-1950s. So if we're in stage 4, the question becomes, what do we look at into the future to kind of guide us that we may be out of stage 4, which is bullish for stocks. Stocks typically, by the way, make about 9% on a monthly annualized basis when we're in stage 4. Stage 4 lasts for an average since the 1950s of 6.9 months, just nearly 7 months. And it's been in stage 4 about a third of the time since the mid-1950s. So I mentioned before I would put a more practical indicator in terms of where the stock market might peak out. So what we got here is inflation-adjusted stocks, the inflation-adjusted S&P composite. and underneath is the US leading indicator as published by the OECD. This is not a very well known indicator, but I find it to be very, very useful. And one of the reasons is when it peaks, pretty consistently, you see stocks decline. By the way, the red highlights represent a recession. So in other words, what's happening here is the economic indicator is peaking, market goes sideways and anticipating, and it starts to go down in anticipation of the recession that follows. But you'll also notice that, I should also point out that sometimes we get a situation where the indicator peaks out, we get a mild temporary drop in the stock market. And the reason is because it's discounting not a recession, but a growth slowdown, where the oscillator comes, where the indicator comes down, maybe bounces off zero, or like it does here, or maybe goes slightly below it. But the degree of the economic downturn is not that high, so the indicator, the market doesn't fall that much. But you also notice that here's a peak here, and there's another peak, and the market moved up. And you might say, oh, well, that was a failed signal. It was in the sense if you're measuring it against the market. But if you're looking at stock buying opportunities, and I put in with the dashed arrows these false negatives to the market. If you put in a breadth measurement for the market, you see that something is going on under the surface. So here we have an indicator which measures or monitors the percentage of industry groups, S&P industry groups, that are in a positive trend or have rising momentum. Let's just extend those dashed arrows where we had the failed signal as far as the market was concerned. See what happens to the internals in the market. So I can show you there that the number of stocks in a positive trend was declining as the market was moving up. So the market made you feel very comfortable that everything was okay, but everything under the surface wasn't. It became a lot more difficult to invest and buy stocks that were going to appreciate when more and more groups were falling into this declining trend. Right now, we don't have to worry about the indicator peaking because both it and the oscillator at the bottom here are both in a rising trend. So this is something we're watching as it gets higher to when it starts to turn over. That won't tell us we're going to have a bear market, but it will tell us that we're going to get into a situation which will make it more difficult to buy stocks, either because the market's going down or because there are fewer and fewer groups participating. There's one other indicator I wanted to draw to your attention. It's the most consistent indicator that I've come across. It's the dividend yield momentum. So what we do is we take the dividend yield on the S&P and create a momentum indicator from it. And because the yield moves inversely to the stock market, we've inverted it. That's what this inverting up here means. So let's take a look at the idea that you want to buy the stock market when the indicator drops below zero and starts to turn up. There's been 16 signals since the 1960s. And if you watch through all of them, you'll find that the stock market rallied quite nicely after each of these signals. So it's been very, very consistent, and it bottomed in early 2023 and it's been moving up ever since. But what about the sell signals? Well, that's when we peak out and cross below the moving average from a higher level. And that has been fairly consistent as well, although I have to point out to you a couple of failures with these dashed arrows again. But right now, that indicator is in a rising mode. It's a little bit, I wouldn't say it's overstretched yet, but it has obviously got some way to go if it's going to reach the kind of level it did in 2021, 22. So as long as it continues to move up, it's in a positive trend, and it makes us very happy. And talking of happiness, I'll turn it over to Tom.
Okay. Thanks, Martin. Appreciate that. And also appreciate Joe and Martin, both of you having been co-founders really of Pring Turner and the namesake of our company. We're grateful to you guys and the good work you've done over the decades and building models and barometers that we use today. And we certainly work to improve those models as best we can and adjust as the world changes. We like to change with it. So Jim and I are going to talk about what all this means for your portfolio. And basically, we've broken it down to the 4 R's. And the 4 R's are, number 1, remain positive. That's the first R, and that's based on our barometers and how we read them currently. So number 1, we're going to remain positive. But then we're going to talk about 3 investment themes that tie into that whole inflationary cycle that could be with us for quite a while. We're going to talk about royalties. We're going to talk about the reindustrialization of the United States. And we're going to talk about real estate investment trusts in portfolios and how those will help us with the inflation cycle that's ahead. So the first R, remain positive, is just as we move through the business cycle, we look to gauge risk versus reward. And so today as Martin was pointing out, our indicators are still positive. We'll give another example of that. It puts us in growth mode. In other words, it's blue skies and sunshine out there right now. We're always going to be on the lookout for, clouds on the horizon. We might see a few way out there in the distance, but we're going to keep an eye on those. But for now, we're in growth mode. We've been in growth mode for a while now, and we're going to stick with that positive outlook as long as our barometers stay positive. And so far, we'll show you an example of that with our advanced investment barometer. You probably remember seeing this. We just had it in our most recent newsletter. This is a model that includes a number of different trend, momentum, and what we would call inter-asset relationship. So for instance, stocks relative to commodities would be one inter-asset relationship. So the primary function of the investment barometer is just to warn us about major bear markets and the most dangerous periods out there. And those happen when the barometer's in the red zone on the graph there at 30% or below. That's where we're going to take the defensive steps. The barometer's not perfect. It's does have a credible record though. And if we go back to 1966, the history on this chart only goes back to 2000, but the actual price history goes back all the way into the 1960s, almost 60 years ago. When it's in the green zone, above 30, 11.3% compound growth rate for the New York Stock Index, and that's just price only. That does not include dividends. But when it's in the red zone, the returns are negative 6% on a compound growth rate. So you can tell that it would be a very valuable tool and one that we pay close attention to. Should the barometer start to weaken, we would take some gradual steps, just as we did in 2022, to move your portfolio into a much more defensive position and get into a wealth protection mode for you. Next, we'll take a look at how we would do this in a typical conservative growth portfolio. So if we take a look at the left side of the blue line on the chart will show the range of stock allocation in a portfolio. So we'll at the very highest exposure, near 70%, only one on our models in favorable positions. But when we're in protect mode, we'll be in the 30s and a much lower exposure to stocks to protect the portfolio. And then the bond allocation will range also. So generally in a bad period for stocks, we're usually going into recession. That's usually when interest rates will come down and bond prices will do well. So we'll have a higher allocation to bonds as we reduce the allocation to stocks. And we'll probably have the cash allocation or cash equivalents higher as well if we go into protect mode. So where are we today? Well, on average, for conservative portfolios, we're at about 64% in stocks, 23% in bond or bond type. For us right now would be short to intermediate term bonds, as Martin had mentioned. Our bond barometer is not positive right now, but what we would have a laddered approach. So our average maturity is only like 3 years or so. We're going to have a very defensive position even in the bond side at this point. And then our cash or cash equivalents are at about 14%. So that's just the kind of the overview of where we're at based on our models and what you can expect in portfolios. Also, what we'll do next is take a look at some specific investments within portfolios and ones that typically benefit from inflation, actually. And so Jim's going to take over with specifics and go over the second R, which is royalties and what that means for you.
Thank you, Tom. And as Joe really talked about in his part of the presentation, and Martin as well, talking about stage 4, the inflation implications on investments is large at this point of the business cycle and something we really want to take into consideration. So the investments that we outlined today, not only do they start with the letter R, which is key, but they also would do well, we think, in these inflationary environments. So the first investment that we'll talk about, it's going to be a certain type of investment that was really made famous, I think, by this gentleman here. This gentleman is a venture capitalist. You may recognize him. He's on TV on the show Shark Tank. His name is Kevin O'Leary. And he is one of the venture capitalists on the Shark Tank show, which is a really cool show where anyone that has their own business or business idea in some cases or actual business will go onto the show and they will present to 5 venture capitalists and try to sell a portion of their business to these venture capitalists. Kevin O'Leary here, one investment that he's very famous for and that he likes to do, the way that he structures these investments, is that he does a royalty deal. So you may have heard of royalty before if you've watched the show, but a royalty is essentially, it's a share of future revenue in exchange for an investment. And this diagram here, we'll walk through it in a little bit more detail, but essentially you'll have a royalty company. And what they do is they make upfront investments in a business. The ones that we're going to go through here are actually mining businesses or operators for precious metals. So gold miners or silver miners or copper miners. What they'll do is they will accept this upfront investment to help build out their mine and projects. And in exchange for that upfront investment, what they promise to the royalty company or the royalty investor is a share of future revenue. And we think there's some benefits to this type of investment, not only for the operator, but also the royalty company itself. So there's 5 key royalty advantages. One of the items, and this is very key, as Martin pointed out in his chart of the business cycle and the different stages, there's stages of the cycle where earnings are going down or slowing down. And actually, perhaps even some companies, mining companies, are actually losing money at those times of the cycle. A royalty company doesn't have that same issue. They're still profitable throughout the entire business cycle. Now, they might not certainly make as much money at certain parts of the cycle as other times, but they're still always in the green due to the way that they structure those investments, which is a huge advantage. Another advantage is that it's a term called asset light. So after they make the initial investment, all the operations and management of the projects is now on the actual operator itself. Another large advantage is that there's optionality or big upside with limited downside. They're making projections for what a certain mine will produce, But in some instances, a mine might produce 5 times, 10 times, 20 times, 100 times what the actual initial projection was. The fourth advantage is that they're diversified. So they have hundreds of projects across multiple jurisdictions and areas. And the fifth advantage of this business model that we see in being asset light and after the initial investment not having any obligations is that the company has a lot of excess capital that can be paid out in the form of dividends or share repurchases, and they're reliable and growing dividends. And so the companies that we're going to share here have a long history of not only paying dividends, but growing dividends. And when you compare that against the actual miners themselves, they're far superior income over time. We've created a Pring Turner Royalty Index to kind of give you an idea of how those have performed over time. And this chart goes back to January of 2008 and runs through May of this year, 2024. And the blue line is what we call the Pring Turner Royalty Index. It's really an equal weighted index of a few precious metals royalty companies that has earned a compound annual return of 12% over that time frame. And the gold line here is the Philadelphia Gold and Silver Index, or with the ticker symbol XAU. That is a gold and silver mining, the actual mining operators. So the companies that the royalty companies are giving money to, this is how their shares have performed. So you can see over a long time horizon, the actual miners and operators have not performed well at all. It's been a very difficult environment. In fact, it relates back to the chart Joe showed. It was a low inflation environment, and gold prices, really went sideways for a long time. So it's a difficult environment for the miners to make money. The royalties companies that invested in those companies and made royalty investments did extremely well, 12% annual return over that same time frame. So we think this shows that royalty companies really have a lower risk business model, but also have had strong outperformance over the long run. And we think it's not, it's really an investment you can hold over many parts of the business cycle, but should do extremely well during an inflationary part of the business cycle. So you may be wondering, what are some of the royalty investments that you have in your accounts? And these are some examples. Wheaton Precious Metals, Franco-Nevada, and Royal Gold are some of the largest precious metals royalty companies and made up that Pring Turner Royalty Index. The other one that I'd like to point out here is Texas Pacific Land Corp. It's a little bit different than a royalty company, although we think it's really the same type of idea. Actually, Texas Pacific Land Corporation was formed in the late 1800s. It was Texas Pacific Land Trust. And long story short, they came to own about 3.5 million acres of land in Texas. And over that time frame, they've earned grazing rights or mineral rights or royalty payments from the land that they own. But lo and behold, due to technological advances here recently from fracking, not only did they have grazing rights, but they also extremely increased the amount of oil production on their land. But what's nice about it is they don't actually make any of the investments in the drilling themselves. They are strictly earning royalties from other operators that come in and lease their land. And so it's another asset light type of business model that has really grown over time. But we think it's another good example of a royalty type investment. And we would throw that in with there. Although that performance of this particular investment wasn't included in the royalty index, to be clear. With that, I'll let Tom take the second R of market theme that we think would fit in with the inflation opportunities that we see today.
It's reindustrialization and the revival in the manufacturing sector is in full growth mode right now. And as we can see from the chart that Jim's going to show up on the screen here, this is just one example of it, with the amount of private construction spending is just skyrocketing here. Just in the first quarter alone this year, there have been 42 what are called mega projects. Those are projects of more than $1 billion or more announced here in the first quarter. They totaled over 130 billion plus. And so these are, you've probably heard about the CHIPS Act, where Congress approved certain incentives, tax incentives and so forth, to build computer chip manufacturing here in the US. All kinds of projects going on right now. And we think this is a durable thing that's going to go on for quite a while longer, maybe a decade or more. It's been going on, but it really accelerated. Of course, the COVID pandemic made it painfully clear that we were overly dependent on overseas manufacturers for critical, products. So we're scurrying quickly to what we would call reshore the jobs back to the U.S. So obviously the benefits are we're going to have, some increased job opportunities, whether we're reshoring or what another term is used, nearshoring, where we might bring production back to Mexico or Latin America, somewhere close by. These are opportunities for a lot of companies to benefit from, and we think there's a lot of companies in your portfolio that will benefit from these trend to reindustrialize the U.S. Certainly, the beautiful part is these companies will help bring just the latest technology, and they really be able to enhance productivity. Making products here versus overseas is wonderful. There is one drawback to it. It's probably going to be more expensive building it here in the U.S. than say in China. So that is another factor in this tailwind of inflation that could be with us for longer. So there's plenty of benefits. There is that one unfortunate disadvantage to bring in production back to the U.S. How is your portfolio invested in this theme? Well, there's plenty of companies, and here's just a few of them. Eaton, for instance, just an absolute powerhouse in electrical and power management systems. They serve the commercial area, industrial companies, aerospace, vehicle production, utilities, data centers that get built out to meet this new AI demand. I mean, they're in the middle of all of it. Cummins engine, originally founded over 100 years ago, making diesel engines. Well, now they're making natural gas vehicles, hybrid. They're working on fuel cell technology. Their powertrains serve a variety of manufacturing companies and utilities. So it just weaved throughout the industrial area. Texas Instruments there. Most of us think of them as just handheld calculators from our school days. Well, now they're certainly probably one of the dominant semiconductor chip companies, and supporting the Internet of Things. That's where everything has a chip in it. Union Pacific, of course, whether you're shipping the raw material or the finished product, they're the most efficient way to move it around the country. So, terrific beneficiary of this reindustrialization theme. And lastly, in the bottom right there, Prologis is actually a real estate investment trust, but it's an industrial REIT, and their warehouses are they're just irreplaceable. They're located in strategic locations like near highways, airports, the ports, and they claim to move about 3% of global GDP through their warehouses each and every year. So that's how large they are and how important they are. But more importantly, their warehousing is state of the art as well. In fact, if we go to the next page, will be a picture of one of their warehouses. You can see the solar. If you could see inside, if we had more time, I mean, they have all the advanced robotics and material moving automation within these warehouses. But this is, an example of a piece of real estate. Is it a beneficiary of this reindustrialization process? But I'm going to turn it over to Jim, or he can talk a little bit more about REITs in general, which is, I guess that's our fourth R, or last R. So take it over from here, Jim.
Sure. Yes, the final R, real estate investment trusts. Taking a step back, a real estate investment trust is an investment that owns and operates income producing real estate, and they have very large scale. And there's we believe some very large benefits to publicly traded real estate investment trusts as opposed to owning real estate privately, which also does have its benefits as well. But we'll speak to the ones that we think of why we like public REITs. And so the four benefits here that we believe, we'll call these the 4 L's. We went through the 4 R's. Now we're going to go through the 4 L's. The first one is that they provide liquidity, which is nice about public real estate is you can buy or sell very easily on the stock exchange, just like a stock itself. Another benefit that we see being conservative investors, we're always looking at the downside of things. And one of the ways that a lot of investors really lose money in real estate is that they become too leveraged. And what that means is they have too much debt and not enough of their own capital up in the project. And that was really a large issue that happened from the housing crisis right up to 2006, 2007, is that investments were too leveraged. And when this value of the property started to go down, people had to sell their investments at the worst time because they were over leveraged. And today, public REITs have significantly less leverage. They're in great financial shape compared to where they were 10, 15 years ago, and arguably in better shape than they've ever been before. Another benefit of public real estate is that they have lower borrowing costs. One of the huge inputs into real estate is the amount of leverage that you have on it, but also the cost of that leverage. So if you have significantly higher interest that you have to pay for your debt, that is a disadvantage. And so these publicly traded REITs can access the capital markets quite easily and get very attractive borrowing costs compared to if you or I were trying to get a loan on real estate. It's going to be significantly higher interest rate than what these public companies, these public real estate investment trusts can get. And the final benefit is to fit it with the L. I'll call it locations, but really it's diversification. They own hundreds of investment property, depending on what the REIT is itself, there can be thousands of different investment properties within one single REIT itself. So why would we want to invest in REITs now? Why is there an opportunity? What are we seeing? Well, as you know, and Martin went through, there's definitely business cycles, and real estate prices are tied to the business cycle, certainly. And this history going back to the 1970s shows the National Association of Real Estate Investment Trusts equity price index over time. So this is to give you an idea of what the typical REIT investment had done over time. Kind of think about it as the S&P 500 of REITs. And so over time, you've seen that we've had these large drawdowns, even in real estate. Over time, it's gone up, but there are certainly moments where you've had these large drawdowns. So in the 1970s, you had a 48% drawdown. In the late 80s into the early 90s, there was a 39% drawdown. During the tech boom, we had another drawdown of 33%. And then this big boy here on the chart, a 71% drawdown during the housing crisis and the mortgage crisis. So you do get these drawdowns from time to time, and they're obviously not something that you'd want to ride through. But the good news about this is after you've had those drawdowns, historically, you've gone on to have very strong forward-looking returns. So these are the returns over the next 5 years after you've had a 33% drawdown. So you can see after those large drawdowns, you've had very good returns. And what we're seeing here today, the rise in interest rates that we've had over the last couple of years, we've had another drawdown of 36%. And so we're showing here is, perhaps history will repeat itself to a certain degree, and we like the risk reward opportunity that we've had here. So this puts a table to showing the actual statistics of the performance of the index over time. And so you can see the 5-year forward total returns are very promising. We're not saying that that's going to happen exactly again during the next 5 years, but we do like the risk reward. We think it's in our favor. And as we wait, the other nice benefit of REITs is they pay a good income over time, which will also have a history of rising. So I'd say, the average dividend yield of the REITs that we have is anywhere between 3.5% to 4.5%. So we're getting paid that while we wait for potential appreciation in the actual shares themselves. So summarizing this, investing after major drawdowns, we believe is a low risk opportunity, and why we have a larger than normal allocation to REITs at this time. These are 4 of the larger ones that we have. Tom already talked about Prologis, so I won't go into detail on that. Public storage, the bright orange one here, is you're probably familiar with seeing, if you've driven across the country at some point, you've probably seen the bright orange warehouses over time. It's a self-storage business, a very steady performer over time. The other 2 investments that I'll talk about, maybe a little bit less familiar with, the one on the top left, Equity Lifestyle Properties. They own and operate manufactured housing communities, and they're typically on the coastal region of the United States. And normally when you think of manufactured housing, you probably maybe don't think of a luxurious or, premium lifestyle, but these communities that they own and operate have wonderful amenities, are beautiful, and it's a great business because they actually are just in charge of maintaining the infrastructure to these communities. And individuals themselves, I believe over 95% of the actual people that rent from Equity Lifestyle own their own manufactured home. And so they're just paying for the rights to use their property itself. And so manufactured home is a very low cost form of housing. So we believe it's going to be very economically resilient. In fact, you could see an uptick in the amount of manufactured homes bought and purchased during an economic downturn, just because it is a lower cost solution than typical single family residencies. And the final real estate investment I'll talk about is Mid-America Apartment Communities. They own apartment communities, but not across the whole United States. They're really located in the Sun Belt region. So we're talking Florida, Texas, the Carolinas. And what we like about this area in particular is that you're seeing net migration into these areas of the country and continued growth over time. So that's a good secular backdrop. It's been happening actually for the last several decades, but it's just continuing to grow here as of time. And as Tom mentioned, the reindustrialization, that's where a lot of the jobs are being created in these areas. So it should be a good backdrop for housing over time. And it's just another company that has a long-term track record of strong returns and good capital allocation in terms of growing their dividends and opportunistically buying these communities when they can get them undervalued, or producing their own communities, and also, selling when the price gets high. So that is another one of the REITs that I'd like to point out there. So just to summarize what Tom and I have talked about, as we mentioned, our indicators are still positive. We're on the lookout for potential storm clouds ahead, but for now, the sunny sky are in the forecast. So we're staying positive, and because of that, we're remaining on offense. And some inflationary investment opportunities that we see given where we are in the business cycle. We've talked about royalties, we talked about the reindustrialization, and we talked about real estate. So with that, I'll turn it over to Pamela, who's going to talk about some of the final takeaways, and then we'll open things up for your questions.
Yeah, thank you so much. And thank you, Katie and Jim, Tom, Joe, and Martin for sharing your expertise and your thoughts today. Katie talked about how you can sign up to send and receive your documents securely with us moving forward. We highly encourage you to do this. Then, of course, Joe did an amazing job talking about inflation and how volatility is back. But we are prepared and we are staying alert and on top of it for you. So don't worry, we've got your back there. And then Martin is so amazingly just covered how we're currently in stage 4 of the business cycle and talked about some of those opportunities there. And Tom and Jim did an outstanding job talking about how our active strategy is really still ready to take advantage of any inflationary investment opportunities for you. So I did see some questions pop on in while the presentation was, ongoing. So thank you so much for those. But then for any of you who saved your questions until the end, feel free to start sharing them with us now. Again, they will remain anonymous, and we look forward to having this discussion.
So the first question I have for the team, this might actually be for Martin, but we always do popcorn style, so feel free to chime in if anyone else wants to answer. Is stage 6 of the business cycle cash? Can you explain this a little bit further, please?
Well, stage 6 is the worst time in the cycle in which to get invested because all 3 barometers are bearish at that point. Fortunately, it doesn't last very long, and if it's a crisis that's going to apply or occur, it tends to occur in stage 6.
Perfect. Thank you.
I would just add to that, we're never 100% invested in any asset, and we're likely to have a lighter exposure to stocks in that period, but bonds generally tend to do okay in stage 6, better than stocks. And then of course, cash holds up well. So yeah, fortunately, stage 6 does not happen too often. In fact, I can't remember the last time we had stage 6. It's been quite a while.
Perfect. Thank you. Next question. Have we dodged a recession? Everyone said we were heading for one in the last couple years.
Well, there's always another recession because that's the way the business cycle operates and has operated for 200 years. It's really a question of whether you get a recession or whether you get a slowdown. And in 2022, we had a slowdown. Everybody thought it was going to turn to a recession, but it didn't. And right now we're in a recovery mode. And the next time we go down, perhaps that will be a recession. We'll have to see how that plans out. So we need to follow the data rather than try and have an opinion on what's going to happen.
Yeah, and I would just add to that, probably coming out of the COVID, where they shut down the economy all at once and then tried to restart it over time, as we kind of had different segments of the economy doing better or worse. Certainly during COVID, we had some supply chain issues, and manufacturing was trying to keep up with supply. So manufacturers did well, but then people couldn't go out and eat or travel. And so the service side of the economy was in recession. But then as the economy picked up steam and people were able to travel again, the service side has done pretty well. And maybe manufacturing has slowed down a little bit. So it's been kind of a rolling, we'd call it a rolling recession through that period. Quite unusual, but at least at this time, it seems like things are starting to normalize, and they're moving up together in a kind of a slow fashion right now.
Perfect. Thanks, Tom and Martin. Next question. As a client, how do we stay educated about the market and changes to companies without falling victim to opinion pieces? Or is there any value to opinion pieces?
That's a good question. I guess I'll take a stab at it. I think that's part of our job, is just to read a lot. And unfortunately, there is a ton of information. The unfortunate part is maybe 90% of it is kind of garbage. So we have to filter through the good versus the bad, and it's not easy to do. But that's part of what we actually enjoy doing, believe it or not. So that's my crack at it anyway, is trying to stick with our disciplines. We have a process. If we stick with quality, value, income, stay within our disciplines, and look for opportunities that match what we've always been competent at.
I just put an exclamation point on Tom's answer to that question, and it's a great question, because we have a saying that Wall Street is designed to separate you from your money. And that comes because there's all kinds of opinions out there. But long ago, we recognized that it is discipline and having a decision-making process that takes opinion out of the equation. So the fact is, Pring Turner has a very disciplined decision-making process. Martin just took us through the 6 stages. Those are not opinions when we're in a stage. Those are actual numbers. They're moving averages. They are a composite of indicators that tell us what stage we are in. So that's not opinion. Those are facts.
Perfect. We are getting many questions coming in as well, team. So this is awesome, but let's try and keep our answers, if we can, to maybe 30 seconds, maybe 45 seconds, and get through some popcorn style. But this is fantastic. Okay, so next question. AI, NVIDIA specifically, seems to be in the middle of a speculative fever. Are they near their peak?
Jim, yeah. Oh, go ahead,
Tom.
Joe first.
There is a saying, and I think it was perhaps John Maynard Keynes, that the markets can stay irrational longer than I can stay liquid. So who knows where where that speculative bubble ends, but you're wise to recognize it as a bubble or a speculation, and we've seen a lot of these over our history, and as we've said many times, they do not come to a good end. So speculation, but markets can stay irrational longer. So it doesn't fit our criteria for quality and value, certainly, or income. So
yeah, and I would just say there's a difference between a company and the stock itself. And this was true at Cisco as the internet darling back in 2000. Certainly as a company continued to do well for decades afterward, but as a stock, it still has not returned to the price it was in 2000. It's been almost 25 years now. So plenty of our companies are benefiting from AI. And so they're going to be the beneficiaries of using the AI technology. And I'll leave it at that to keep the answer as short as possible, Pamela, for you.
Perfect. And then the next question I have is, how do you know that the REIT drawdown is complete?
Maybe Jim.
Looks like we're having some audio connection issue from Jim for just a second.
Okay, well, he had that segment, so I was going to dish it off to him, but that's okay. Well, we really don't know exactly if we've seen the bottom, but we do use technical indicators for individual stocks and groups in terms of looking at momentum, the price history, and we do our best to invest when we think the risks are low and the opportunity is high. And we see that not only fundamentally, but from a technical aspect as well.
Just to add to Tom's comment, how do you mark the end of a drawdown is fear. So we measure sentiment that tells us when we're approaching tops and sentiment when we're approaching bottom. So a drawdown or a bottom in the stock market is basically the point of maximum pessimism. So we'll be able to cut the fear with a knife out there. That's the bottom. That's the end of a drawdown.
Perfect. Thank you. Thank you. Next question is, how will the upcoming presidential election affect the markets?
Joe, you've been around probably longer, seen more presidential elections than any of us. You might even go back to FDR. So I'll let you take that one, huh?
I would say it won't affect it a great deal, in the sense that there'll be a lot of speculation ahead of time as to, and knowledge and where we're going. But what you'll probably see is, over time, the policies that come out of whoever the president is, and that's part of the answer. And the other thing is, the economy is greater than any elected president. So the economy is really going to dictate events, not the president.
I think I would agree with that. What we see in most election years is the prices of stocks move up towards somewhere towards the end of the year, and fully discount any good news coming from out of presidential elections.
Good answers, team.
Like Joe was saying, the economy is slow to turn. It's like a tanker, an oil tanker. It's slow to turn. And when you get something like that, it's going to be taking a long time for the economic indicators to start to turn down. Therefore, the presidential election really doesn't have a lot of influence unless something untoward happens.
Good answer, team. Thank you. I know that was a question that was actually asked twice, so that's great. And next question. And let's try and keep our answers to 30 to 45 seconds again, just because we have several more to go through, which is awesome. Thank you everyone for your questions. How do I get my vault set up? What is the process, or what do you need from me?
Tell you what, anybody that wants to set up their vault, you can just call me anytime. You know the main Pring Turner number. I'll get the email set out for an invite and get you all set up. So just call me anytime, like for any other question you might have. So I'm available.
Kate's awesome. She makes it very easy. So it sounds that simple because she makes it that simple for you. So yes, feel free to reach out to Kate and she will take care of you. Anyone on the team can also take care of things, but Kate is the guru.
Yep. Text, call, email. We do it all. So.
Perfect. Okay, next question. What indicators would you watch to determine if the current inflation spike is temporary or the start of a longer-term trend?
Well, one of the things I'd be looking at is the gold chart, because gold leads commodities and commodities lead the CPI. And the gold chart is very important right now, because if you adjust it for inflation, it's running up against a very, very important trend line or resistance level. If it goes through, that will be, and that line goes all the way back to 1980, even though the nominal price of gold is up substantially since 1980, the inflation adjusted is actually below where it was in 1980. So that's something I would watch very carefully if that breakout takes place. And we're literally right at that line as of today. Of course, we don't know until the end of the month, at the monthly close, where we should be charting it. But that's a very significant thing. Another thing would be to take the ratio of commodities to bonds. And that ratio is now has been in a trading range for the last 30 or 40 years. It's very close to an upside breakout. Sorry, that's a bit more than 40 seconds, but
that was nice and detailed. Thank you, Martin.
Let me add to, Pamela, if I could add to Martin's observation there. Another way that we could measure whether it's temporary or something worse is the Fed has laid out what their target is. They say 2% on the PCE index. We're at 3.5 right now. They also want to lower interest rates. And so I would say the key is going to be, does the Fed lower interest rates because the economy is slowing down before we reach 2%? And that to me is going to be a key check mark or benchmark as to whether we hit our targets and stay low, that in fact this spike is temporary, or we have a longer lasting inflation problem.
Well, the other point to bear in mind, Joe, is that we've always had inflation on a year-over-year basis. There are very few months, like in the 1930s and 2009 or 2008, when prices actually slipped on a year-over-year basis. So this 2% target the Fed's going for is actually a 2% tax on savers, because it comes cumulative every year. So 2%, there's nothing magic about that. It's just a number the Fed has drawn out of the sky.
Yeah, I am very disappointed that our government sits there and says our goal is to rob you of 2% of your wealth each year.
Well, thank you. That was a thorough answer. Next question is, currently there appears to be a lot of momentum in the market towards small caps and industrials coming out of last week's below consensus CPI. The move seems attributed to the concept that the Fed will lower rates. Does Pring Turner see the Fed lowering rates, or is the inflation impulse too strong?
Okay, that's a well thought out question. I would just say the market is looking, or investors are looking for the Fed to lower rates this year. It looks like there are going to be at least 1 or 2 rate cuts this year, just from looking at the futures markets. I think more importantly, the actual bond markets are moving ahead of the Fed. So if we just look at, say, the 2-year Treasury note, it's gone from over 5% here not too long ago, and it's come down quite a bit, probably reflecting that the Fed will follow suit at some point here. So I think better just to track what the 2-year rate's doing, and that'll give you an idea what the Fed will end up doing.
Perfect. Another question, and thank you, Tom. Thanks for that answer.
Mm-hmm.
And another question is, all investors make mistakes. How do you decide when Pring Turner makes a mistake or there's a learning lesson?
I kind of take exception to that question, Pamela, about everybody makes a mistake. I have not made one yet. So I just want to put that out there.
A fair question. I think probably that's why we build a lot of different layers of risk management into our process, because we do make mistakes and we never are going to be 100% correct. That's why we focus on quality. So, quality tends to hold up better in bad markets, for instance, and value tends to have more reasonable valuations, means there's probably less risk to go down a lot. And of course, income is another factor we throw into portfolios. If we have good paying dividends, even if we're wrong on the timing, at least we're getting paid while we wait for the stocks to do well. So those on top, of course, the business cycle work that Martin does helps us in that approach to reduce the risks as much as we can. But over time, certainly we've had periods where markets have surprised, whether it's COVID or great financial crisis. And we've had a good history of holding in really well because of all those disciplines that we've incorporated into the process.
Yeah, I just quickly
might have misspoke
Jim's
about not
back.
making mistakes. We start out with the fact that there's risk in everything, and there are risks that we can't identify today, none of us. And so we literally have spent our career, as Tom pointed out, of of building layers of protection around the portfolio, because we don't know where that risk is coming from. We don't know, was there a COVID coming? We had no clue. We did have a good defensive fence around the portfolios, and that's what we've done. That's what Pring Turner is about. Is there are many, many layers of risk protection around your portfolio, and Tom just mentioned some of them, but you can keep taking off a layer of protection, and there'll be another layer that we have put into your portfolio.
Thank
you
you,
hear me,
Joe.
Pamela?
And I think Jim's going to add a quick thought before we go to the next question.
All right. I'll just say we definitely make mistakes. I'd say probably one of our biggest, if you want to call it a mistake, as Tom mentioned, is that we're very conservative in that we don't want to take outside risks. We want to try to generate steady returns and not make any of our clients poor. And so if you want to call that a mistake, that would probably be one of our, we might not be as aggressive as we could be at certain parts of the cycle. And that's because we think the key to investing, good long-term investing, is lasting and making it through each cycle so that you can enjoy the next upside of it.
Nicely done, team. Great answer there. Next question is for Martin and Joe. What are Joe and Martin's current roles in the company? Advisory, ? Are you involved in other aspects of the team? I know that, Jim, myself, Katie, and Tom were more forward-facing, but it'd be great to hear more about your support and contributions to the team.
Well, as you can, excuse me, maybe you better take this first of all, Joe, while I clear my throat.
Well, I think Martin and I probably bring two different things to the company, as we have, for the last 40 years or however. But Martin certainly is looking at many of the intermarket relationships, that whole issue of looking at asset allocation, what things are working, what things aren't. So Martin spends an awful lot of time doing that. I spend a little bit more time maybe spreading the message of Pring Turner. I've just finished giving a 3-week course on inflation and the issues and the problems for a research firm. So just contributing ideas and marketing is where I have, and Martin, if he's ready, just makes contribution of concepts, ideas, asset allocation, intermarket relationships, a lot of the technical side of analyzing the markets.
Yeah, I try and feed as much information as I can to the guys running the portfolios, and try and do my best to figure out where we are in the cycle and what probably is coming next, and have some ideas as to what they should be looking at, what we should be looking at, and taking it from there.
Perfect. And also I will add, Tom mentioned it earlier in the event that, Martin and Joe started Pring Turner. That's Martin Pring and Joe Turner. So they're our founders and are just the most intelligent and experienced in the industry. They're just outstanding. And so their contributions go beyond what they just shared now. They are just this incredible force and foundation to what Pring Turner is, what our values are, and what we will continue to do for clients moving forward. They are just part of that driving force.
I second that.
Okay, we have a couple more questions. And then it looks like, I think that's it for now. So next question. How do you consider the studies that indicate that the current market might be grossly overvalued when Pring Turner as a team believes that there could be more ahead?
More, what ahead, Pamela?
That there could be more ahead in terms of the market
Yeah.
and
More
opportunities.
upside? Okay.
One of the things, valuation is not a very good timing tool. We've been overvalued for several years now. So we can say the market's overvalued, and we can also say there's a lot of momentum and it's going up, and the models, as Martin and Jim have and Tom have explained, there's still a green light out there. So I think valuation probably comes into play if we look at a long-term time frame. If we look out at the next 10 or 15 years, today's high valuations will probably show themselves in having values come back down to earth over a period of time. So yes, we're overvalued. We've been overvalued for quite a period of time, but we still have green lights.
Well, I would add that if we look at the S&P 500, it's really highly concentrated right now in less than 10 companies. And a lot of those companies are growth companies that are quite high valuations. We were talking about NVIDIA earlier, but you could talk about Meta or Amazon, Google, the rest. Their valuations are quite high and they're quite large in the S&P index. If you strip out those and look at the other 490 companies, their valuations are closer to maybe 17 or 18 times earnings, which is actually not too unreasonable. So that's why we're value investors. We're looking for, where we can find the best risk reward for clients.
Excellent. Thank you so much, team. That was a fantastic response. Okay, next question. Maybe this might be for Jim, maybe Tom. Much has been written about the real estate banking crisis. How do you consider our investments in the selected REITs in the context of this situation?
I think a couple things. One, you've already seen a major drawdown in the REITs since the beginning of 2021 when interest rates start to rise. So I think that's already being priced in and why we're getting them at a good valuation, or what we think is a good valuation. There's another question I wasn't able to talk at the time, but how do you know that the REIT drawdown is over? And we don't know that it's over, but I don't know if I talked about this during my slides, but I should have. Those declines there in those forward returns were after you've had a 33% decline. So we've already had the 33% decline. So that time frame, the next 5-year return, is already starting. So obviously, during the last major drawdown in 2007, 2008, when it was down 71%, you still had a long ways to go before the bottom, but you still had solid, 5-year forward-looking returns. So I'd say that's one thing. The other thing too is it kind of gets to what Tom was talking about in the Q&A, that you have an interesting landscape where not all real estate is the same. And the real estate that we're invested in specifically, we feel like it has some good long-term demographics and tailwinds behind it that are going to keep it in good shape. And as I mentioned before, the companies that we own are very high quality. They're less leveraged. And in fact, if there is some sort of mortgage or some sort of real estate crisis, then they could be opportunistic and look to purchase additional properties. So I think, it certainly could happen. Corporate real estate or business real estate, there's lots of question marks there. We're a little bit too much for us. That's why we're not really focused on that area. But, I think anytime it's out in the media and everyone's talking about it, it's probably already factored into the prices. But I'm sure we'll see some more problems, going ahead. But I don't think it will affect our individual businesses that we own.
Thank you, Jim. Thank you for that great answer. And we have 2 more questions, and then we'll wrap everything up. The first is, I didn't see any discussion on foreign investments. Is there any type of foreign investment vehicles in portfolios for diversification purposes?
I'll jump on that quickly. We talked about, that was last year's client webinar mid-year. We talked a little bit about international becoming more compelling relative to US in terms of a valuation perspective. So we do own some funds that have some exposure there. It hasn't been a place, the trend has been in the favor of the US for a long time, especially the last 18, 24 months when the S&P, and as we've all kind of mentioned, you've seen these large mega cap US tech companies really dominate. But it's certainly an area that we're watching. We have some exposure to and could, add some more there. Maybe Martin, I don't know if you want to give an update. You're looking at these relationships of US to international. Any thoughts there?
Yeah, there's no question that when you look at the S&P capitalized, that the US market has outperformed the rest of the world very handsomely. The problem is when you take the unweighted S&P, it's about even. It's still an uptrend, but it's not anywhere near as impressive.
Perfect. Thank you. And last question to wrap the event up. There has been much talk about the growing federal deficit creating an oversupply in the bond market. How do we as the team see that playing out for our portfolios?
I like that term, oversupply of bonds. But what the opposite side of that coin is, we're running huge deficits and we're creating tremendous debt that has to be serviced out there. So that goes to the heart of, I believe, a problem that the Federal Reserve has and yet to be played out. Servicing the debt, servicing all those bonds is really, I think, the bigger issue. You have short-term rates as reflected in your portfolio with these short-term bonds that are collecting close to 5%. That means the government is paying 5% on this 30-something trillion dollars of debt. The interest paid by the government on that debt will surpass the defense budget this quarter. And by the end of the year here, in another 6 months, interest on the federal debt will be greater than what we pay to defend the nation. That's kind of a scary thing. So somewhere they're going to have to address the debt. It also puts the Fed in a conflict. They need to lower interest rates, literally, to keep the U.S. government afloat. So it's like, stay tuned. There's dramas to be played out in that question that you've asked.
And that fits in with what you were talking about, Joe, in terms of a potential inflationary tailwind going forward here.
Exactly.
That might be the gold price is telling us.
Interesting you asked that question on the day that gold hits an all-time high.
That was an answer, not a question.
Oh. I just wanted to pat the portfolio team on the owning gold royalty companies or having a good representation there. It's a good theme, good trend, and ties into that question of the oversupply of bonds or the deficit that the country is running. That's it.
Okay, so that's all we've got. This has been great. Love all the good questions. Appreciate it, everyone, for asking them.
And for everyone who's joined us live or is currently listening to the recording, we appreciate each and every one of you. Thank you for being a part of the Pring Turner client family. And thank you to all of our amazing speakers today. You know who you are, and you're just an amazing part of the team and so deeply appreciated. So thank you again, everyone, for joining us. We hope you enjoy the rest of your summer and look forward to our next event soon.
All right, great. Thank you.